what banks are also perfectly positioned to do is give loans against crypto, and they're going to have a lower cost of capital than any other provider. So if you want to put your Bitcoin in your JP Morgan account and borrow against it, I'm sure they're going to have a product to be able to do that.
This episode is brought to you by Aries Markets. To learn more about Aries Markets, follow the link in the show notes below. Hey everyone, quick disclaimer before we get into today's episode. Nothing said on Bell Curve is a recommendation to buy or sell securities or tokens. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely our opinions, not financial advice. Our guests and I may hold positions in the companies, funds, or projects discussed. All right, everyone, welcome back to another Roundup edition of Bell Curve. You got Michaels 1 and 2. Just the Michaels holding down the fort this week. How you doing, my friend?
Just the two best, you know.
Got the dead weight.
Exactly.
Yeah. It's been a week, man. I feel like this week started off with a massive panic around AI, this new Chinese open source model, DeepSeek. And it was the end. People were calling for the top of the cycle. It was going to be down only from here. And we're basically trading back above where we were at the end of last week. So, yeah.
You know, some weeks, decades happen. Some decades, weeks happen. One of those.
Yeah, this is also one of the classic, like in the depths of we are so over, we found that we are indeed so back. And yeah, it's funny. I actually saw shout out to Hyperliquid and all the Hyperliquid enjoyers. That was actually pretty fast back out of the gate. It's been pretty remarkable. Has it surprised you at all that Bitcoin has held up so well and Bitcoin dominance has extended so far into this cycle? I mean, this far, like post-halving and just generally this far into a bull market, I feel like generally this is around the time or pretty well past when that dominance starts to fall. But Bitcoin has held up pretty well. It actually held up really remarkably well, even after all the DeepSeek news and NVIDIA sold off 17 or 18% in a day. I mean, still, I don't think it ever fell below 100K. What do you think about that?
Knock on some wood there.
Sorry, dude. Yeah, tell me to jinx it. Oh God.
It's like an announcer at a football game being like, "Well, he's never missed a kick before."
yeah, very true.
But no, I think the DeepSeek stuff was interesting in that. We could touch on that first, and then maybe kind of like crypto macro.
Can you just give like a quick overview of the DeepSeek situation as well?
Yeah, so probably for the 20th pod, that if people are as avid podcast listeners as I am, have heard, all of these terms and all of these explanations. I think broadly, what happened is there's a hedge fund out of China that that has been working on, DeepSeek large language model. They on the 20th, so this actually didn't even happen. It sort of took a week for people to kind of get ramped up to the understanding. They announced that they were able to train DeepSeek R1 with $5 or $6 million worth of training resources. Now, what this implies, and the performance of DeepSeek R1 is that it was competitive with ChatGPT-4. At least on initial pass, it looks like it is competitive. It works pretty well. There are still hallucinations. It's unclear as to whether or not it's distilling other resources or other language models in the way that it's operating. So maybe it was trained on some of these models. I think there's still broad questions, but if we take the assumption on the surface of what they announced, which is they were able to train with orders of magnitude less resources than OpenAI has been able to train their models, what does this mean? And this is kind of why there was a market freak out, which is that the expectations around not only compute resources but power resources, NVIDIA resources, all the things that go into what is expected to be, hundreds of billions. You have Stargate being announced at $500 billion of investment that's going into the ground.
Yeah,
calls into question whether or not all of that's necessary. And you had, and so the market freaked out because so much of the expectations of the stock market currently, are built into NVIDIA, are built into the Mag 7, are built into what is expected to be, CapEx spend, infrastructure built out. You even had uranium stocks and nuclear stocks sell off and energy stocks sell off because, the forward-looking expectations on where energy prices will need to go or energy resources will need to go, that calls into question everything. And so massive freak out, massive sell off. I think NVIDIA ended up losing like $600 billion worth of value in a single day, which is the most any stock has ever lost in a single day. I do think it level sets kind of the expectations though. And let's just assume that it's correct for the time being. What this really does imply is that there are better, more efficient ways of training these models. And Mark Andreessen came out and said that this is, AI's Sputnik moment. Well, what Sputnik was, was basically the first satellite to go into orbit and send a signal back to the world. It literally just had like a basic ping, and this invigorated the space race for the United States. Basically said, okay, like it's us versus Russia. We're going to go off and put a man on the moon and beat them there. But it did hypercharge and catalyze a massive build out, a massive infrastructure investment, and everybody was aligned. And so I think the call to arms that Mark Andreessen is suggesting, I think is fair. I don't think, and I think it's appropriate because it's happening right at a point in time when everyone seems to be recognizing that we can't lose the AI race. And the space race may be something equivalent as an example. But it honestly, I think, is a great shot across the bow because it hopefully will force us to start to call into question some of the assumptions that we've made. And just it shows that there is the possibility of lower cost implementations of AI. And so how does that translate? What that means is you had Larry Ellison on stage talking maybe a couple months ago about how if you want to play at the large language model game, it's going to cost you hundreds of billions of dollars to do that, which means that there's only going to be like 5 or 6 different companies that can do that. Whoever has the balance sheet to be able to support that. If you're talking about $5 or $6 million to be able to train one of these models and it's open source in the way that they released it, that means that it's broken down to a level that's approachable for startups. It's approachable for hedge funds in China. It basically brings down the infrastructure level to the point where I actually think that the biggest benefactor of this entire announcement is potentially crypto and AI. And the decentralized approach to AI is actually something that becomes viable if you're able to stack a bunch of Apple hardware together and build and train one of these models. That's a very different process than being able to needing to set up your own gigawatt data center with its own nuclear power station and train these LLMs to be competitive. It's a very different ball game. And so I think Sputnik is a fine example. There was another thread on Twitter that I saw, which I think is actually a really interesting comparable as well, which is Sputnik is probably not the best example. Maybe Google actually is. And the analogy here is in 2004, when Google announced their S1, what they also released is that they had been able to connect together using basic hardware, one of the most powerful computers, distributed powerful computers. And at the time, what you had was all the startups were basically in this race to buy and build the biggest supercomputers, basically from Oracle, because that was the only provider of the service at the time. And what they were able to prove is that through their distributed network technology, they could take basic off-the-shelf hardware, and as long as you had enough of it, it was going to be just as powerful, if not more powerful, than the tens of millions or billions of dollars that all the other startups were trying to compete with Oracle technology. And so that I think lends credence to what is possible now if you have an incentive layer or an incentive mechanism to connect distributed networks and off the shelf basic hardware, the laptops that we're running right now as we're doing this podcast. It opens the realm of possibility. And I was trying to wait as long as possible to use this, term, but everybody's probably heard it. But Javon's paradox. Yeah, it is probably the best description of what's probably going to happen here, which is, and the basic concept is, as you reduce the price of a resource, the aggregate amount of demand actually goes up over time, because what it does is it opens up the aperture lens. It opens up the possibilities of new use cases because it's a lower cost resource. And so if you think about it in economic terms, P goes down, quantity goes up, Q goes up more than P goes down. So aggregate value goes up because price goes down. And I think that it will be the effect that ultimately takes over. So I think this is actually extremely bullish. It just means that what threw people for a loop is their like 12-month CapEx expectations and how those are baked into, stock valuations. And all of the, analysts on Wall Street had to go back to their models and say, oh, wait, what if we're off by a couple orders of magnitude for the next 12 months? For the next 2 to 3 years or 5+ years, fundamentally constructive. But, short-term pain for long-term gain.
Yeah. The Sputnik analogy is a really interesting one. And actually, just as a fun thought, there was an Apple TV show that got produced a couple of years ago called For All Mankind. And it started with it was a great show. And it started with the hypothetical of what if the Russians had actually won the space race. And the way that it actually played out in real life is the U.S. won the space race. We bankrupted the Soviet Union economy, and it just created this ripple effect. And we haven't really done much in space since. But the idea was, if the Soviet Union had actually beat us to the moon, then we would have been able to marshal the resources to actually compete with them on the moon and potentially expand outward. And I think it's a good analogy or metaphor, because I do think that AI is probably the next big strategic race that the two contemporary superpowers, the United States and China, ultimately want to win. And I heard Bill Gurley make this point that I thought was very interesting, which is, the previous administration and the Biden administration, there were all of these actions that they took to limit China's access to compute, to like modern GPUs. And so, in some instances, I mean, this is like the long debate, right? Are sanctions and these sorts of economic, preventative measures actually effective? In this case, it actually might have backfired, because this is like the necessity is the mother of invention. So by not having access to strong enough or like the same amount of compute resources, they actually moved one layer up the stack to inference, and they were able to train at 2 orders of magnitude cheaper than U.S. counterparts. And I would like, you probably looked into this a little bit deeper than me. Sort of anything that comes out of China, you probably have to verify some of this data, but I think it's starting to get replicated across teams here in the U.S. And there's at least some merit to what happened with DeepSeek. And so, yeah, I basically agree with everything you said, that I think that long term, this has got to be bullish, because, if we all believe that the inference that these AIs are capable of is actually useful, then being able to train models it should be super bullish in terms of allowing people to use this stuff. It also is a little funny to see, 6 months ago, everyone was very bearish. These AI startup wrappers, right? There's a wrapper of, GPT. And now that people are questioning the value of the foundational model, actually, maybe those wrappers don't look so bad. And so maybe it is kind of bullish for AI and crypto, right? If you can train a model for much cheaper than we thought, then some of this experimentation starts to look pretty interesting.
Totally. Yeah. So a couple of points there. Well, number one, what they said is that they actually trained it on Huawei GPUs, which exactly to your point. Yes, we limited them from buying NVIDIA chips. Great. They went in a different direction, are now not buying from the US. They're just using, material resources that they have internal. So, oops, bearish NVIDIA potentially if you're a holder of NVIDIA after this. I also think, the CEO of Scale AI at Davos said, we actually believe that they have 50,000 H100s that they just don't, talk about because of export controls. So once again, this is all with the assumption that what they're telling is the truth. Is that a fair assumption? Probably not. But it is what it is. And yeah, I think the it's hard for people to kind of assume that we're in this like equivalent space race until there's basically a counter move, and I think this is a counter move.
Yeah.
And now I think it's time to recognize that we're in a race. If we're plowing, I just saw yesterday that Masa and SoftBank are looking to invest $25 billion into OpenAI. If you have $25 billion of available spend and you're just going to go off and buy as much as you can, and you think that you're like able to win based off of CapEx spend, it's to your point, you don't have resource constraints. You have the opposite. You have resource abundance, and you're never going to operate with a resource constrained and therefore a creative perspective unless you have those artificial constraints. And so I'm fundamentally bullish on not just crypto AI, but definitely AI startups as well. If they're able to basically facilitate the same sort of discovery and launch as DeepSeek was able to, with an order of magnitude or two less cost, it means that you don't have to have the $100 billion to compete. And that's very attractive and opportune for startups that are in this space.
This episode is brought to you by Aries Markets. Aries Markets deployed on Aptos in 2022 and is now the largest lending protocol with $280 million in TVL. To learn more about Aries Markets, follow the link in the show notes below. This episode is brought to you by Marinade. Marinade is a high-performance staking delegation platform that brings both liquidity and security to the Solana network by connecting SOL holders with the best staking rates on Solana. Follow the link in today's show notes to learn more.
Yeah, I think the AI sector will be interesting. And, here, so I want to actually pull up a piece of data here as well. Actually, this might take me 2 seconds. But this is just leading into something that I wanted to get your opinion on here, which is, so there's a group that does a crypto insights group. So shout out. They do this monthly survey of crypto native investors. I think they've got some 54 investors that fill the survey out, and they do a poll of basically where are fund managers interested. But so AI is by far leading in terms of sentiment. It's the most bullish sector fund managers have ever seen. I think the survey has been going on for slightly over a year, with nearly 90% predicting it will outperform over the next 3 years. Just behind that is layer ones and DeFi. And then in terms of, and memes are still, I just flagged it as sort of contested. At the very bottom of this is metaverse, and some of the other less popular categories are LST, restaking, DA, ZK, NFTs, etc.
Yep.
I've got a question for you. When you look at this, putting your fund manager hat on here, do you look at this as like the overall bullishness on here on AI as like a counter signal if everyone is kind of in the same boat and bullish on that, or still could just be beginning of a trend? Because I mean, that's definitely how I feel as well. I feel like the AI crypto narrative is still just getting started.
I think it is just getting started. I think one of the benefits of being fund manager in the space is our job is to meet with entrepreneurs every day. Like that's our core function. And when we are meeting with people who are thinking at minimum 3 to 5 years into the future, there's a lag of like, we want to get started, we want to raise some money to go after this thing that we think is going to happen in X number of years, and that takes time to develop. It takes time to build. I would even say like gaming is a good example here. We started investing in gaming in 2022, really. And a lot of the games that we invested in are like just now launching.
Yeah.
And so it has hit these like peak trough cycles of, you invest a bunch of money, you get really excited about it. And then it's like, okay, then you got to build it. And I think DeFi was unique with DeFi Summer because you could have, 3 smart contract engineers put up, an interface and build, some DeFi primitive. And it was really, moving at the speed of software, open source. And it didn't take very much to get, the math was the hardest part, basically. Whereas when you're building fundamental technology or something like a game that needs depth and richness and content, it takes a really long time. And so I think AI is it's at that peak because we are seeing some of the best entrepreneurs in the space in the AI category right now, but they're still thinking in like multiple years down the road. They're not even thinking about 25 or 26. They're like, 26 is going to be a huge build out year of infrastructure. Maybe we're going to have AGI by then, but agents are going to be kind of the new narrative, in that time period. And like by that point, X, Y, and Z happen. Therefore, we're going to be there for that. And so I think there's like the market reaction, and then there's like the venture market reaction. And so the leading edge of fund managers is probably leading. But I think, and so, if we compare something like ELIZA OS or, formerly AI16, the virtuals concept, like everything that exists right now, I think is going to start to be in that, it's going to take time to build phase, where if you want to build actual technology, it's just going to be a while. Like you're going to have to get, a lot of fingers on keyboards for a long period of time. But I do think, it's about finding the best founders that have the best ways of navigating the idea maze. And AI is definitely in that category right now. And frankly, if you're an AI entrepreneur, the pitch, to joining crypto has never been stronger. Which, and we can talk about this, especially with Jelly. But if you're a founder in the space, and the last couple of years it has been, and maybe this changes with DeepSeek, we'll see. But if you've been deplatformed by OpenAI, like there's that kind of crazy story of like, I think it was winter 2023 class of Y Combinator, and they had like 2/3 of the class building Chat GPT plugins, and basically OpenAI announced a bunch of plugins and like eviscerated an entire class of startups. Like the deplatform risk is real. I also think the competitive landscape, if you aren't able to raise billions of dollars, is real, or has been at least for the last few years, and remains to be seen whether or not that'll be true. I think it is largely true still, but it's capital game. And an AI intersecting with crypto is, if you've got the right construct of a product and service, it is the best place to play. And so I think you're starting to see a lot of the AI entrepreneurs who, have had trouble over the last couple of years, or, are recognizing the power of what decentralized networks and crypto incentives can bring. They're moving over into this space. So the talent is definitely coming in.
Yeah, I think that the other thing about AI that's been really difficult, like any paradigm shift technology, is what people are going to do with it and where value is going to accrue. People love to opine on this on podcasts and talk about it with a high degree of confidence, but just in the last week, I mean, the thought process in this is completely flipped 180 on its head. And basically what was driving the US stock market and keeping Mag 7s high is now like a huge area of vulnerability, and people think value is going to accrue to a completely different part of the stack. At this stage, I would just welcome any and all experimentation that's going on with AI. And Eric Wall had a pretty good tweet thread the other day about, kind of comparing the relationship in like crypto AI and foundational models. Is if you're a foundational model, you're building the skateboard, but crypto is the skate park. And the skate park is going to be a really great way for people to just experiment with doing new cool tricks and things, right? And like the environment that crypto provides is going to lead to a lot of super interesting experimentation. I know everyone is really hopped up on the agent meta in general, and I know people are excited about it doing real stuff on chain for people managing your finances, etc. I still don't hate the idea generally of just creator AIs that have basically tokens attached to them for a couple of reasons, which is one, this is an extension of something that's already happening in real life. You have completely fictitious hologram influencers over in Japan selling out arenas. It would make complete sense to me that the natural evolution of that is actual genuine thought, like an LLM that's attached to that influencer, and having a coin associated with it is sort of just this really old narrative of SocialFi. And one of the big advantages of AI coins are that, you and I don't really want a social, like a token that's associated with me. It just feels weird. Maybe that'll change in my lifetime, and I'll flip how I'm thinking about that. But yeah, I still don't hate the original just use case of, frankly, like AI creators that have tokens associated with them.
Yeah, I think that there's a lot of, so it's a great analogy, the skateboard and the skate park. maybe tying a little bit this back to what we were saying on DeepSeek too. I think one steelman argument for why the infrastructure build out and the capex spend is going to maintain is if you just look at the arc of any sort of like progression of technology, I could go back as far as like my mom worked at Apple, and like one of the things that they were trying to figure out was, do they put 64K RAM versus 128K RAM onto the Macintosh? And it's like, well, how much you actually need, and then it's like, okay, the first iPod had like, I think it was not even a gigabyte of storage.
Yeah.
And like when I worked at Dropbox, if you did the whole sign up flow, you got like 250 megabytes of storage. And that was like your little taste to be able, but like you can't even store a video in 250 megs anymore. And so like the progression of technology moves at exponential scale. And I think that that's what we're seeing in it as well, with the different, developments of, GPT-3, GPT-4, O1, like the ability to have chain reasoning now is like, it's factorial to whatever, the LLM was doing previously. And so I think it is worth it to continue to build out, and probably like will cost a lot more to push the boundaries further on what these models can do. And ultimately, like humanity and consumers of AI services eventually will be the benefactor of this. But, Sam and OpenAI and everybody else who's building this stuff is willing to spend the tens of billions of dollars right now to be able to be first, even if it gets commoditized eventually. Like now, the cost of using or training a basic LLM that isn't as good as, the bleeding edge is probably, $5 or $6 million. And so I think like the cost curves are important here. And as we push the boundaries further and further as to what the technology, the core models can do, I think OpenAI is great. And, they 200 million daily active users apparently of ChatGPT. I wonder if there will be, the point of experimentation as to what the end consumer services are. I wonder if that is something that might take place in crypto, just based off of the level of experimentation that we as an industry have. Like, look at what happened with DeFi Summer. If we were to take the core technologies, and maybe it's not wrappers and startups who are providing specific services, but maybe it's, happening on a platform for agents, and you're asking the agent, hey, can you do this? Hey, can you do that? Or, hey, we used it in this way. Or, the rapid iteration and the experimentation that we have in crypto, paired with the CapEx and massive build out spend to build the core technology and, the Mag 7 plus, I think that's kind of what makes me excited about AI and crypto. It's not that we're going to be able to source all the resources in crypto. I think we're going to source all the use cases in crypto.
And that would be amazing. And I would love it if we were doing this podcast in 2 years and no one was asking, what are the use cases? What are the use cases, right? Like that would be cool if AI was a big part of that story.
And agents is kind of like a broad moniker for what, use cases might be, because an agent is basically just a chatbot, or a chat box with, someone on the back end who's doing whatever you need to do.
Michael, I want to change topics a little bit and actually get your take on, we're looking at that investor survey a little bit, and, the block wrote up this piece based on, to my understanding, that survey, kind of with this idea that fund managers are getting ready to allocate again. And I would love, we've talked a little bit on the pod in the past about, what the allocator sort of sentiment looks like. And, pursuant to that as well, I think there's, you would probably know a little bit better than me, but in terms of the returns of past vintages of fund, I think especially with some of the longer dated venture funds, its performance has been pretty tough. I also think anecdotally, this has been one of the more difficult cycles to invest in crypto, right? Unless you were in it's just been really tough, right? It's a much larger space. There's so much more dispersion than there used to be. And I think returns have been just pretty difficult in general, coupled with the fact that there still haven't been many successful crypto exits outside of token launches for the most part. There was a great, I just found this, but this was an interview that Thomas Lafont did at the All In Summit from, I think, a couple months back, where he was describing the state of the unicorn market. And he had a couple of really pretty jarring statistics on there, that this was there were less IPOs that happened last year than there were in 2008, which is pretty stark statistics, right? So kind of, and his, overall mental model for this is something we talked about on this podcast of just working through this insane bubble in venture that happened in 2021 and 2022. But, I kind of wanted to get a sense from your standpoint of, what's going on from a fund manager standpoint in crypto right now. Like, how have returns been over the course of the last couple of years? What is the state of like the venture and fund management market in crypto?
Two very different conversation points. Maybe first on just like the state of funds in crypto. Dispersion has become very, very pronounced at this point. And it used to be, and used to, let's say, like in the 2019 through 2021 era, you had a concept. Maybe it was borrow lend, maybe it was money markets, maybe it was some category within some ecosystem, and there was like a leaderboard of like who was the best and who were like the next three best. And if you were in the top three, you kind of had like a pretty decent profile of return for that investment. I think what has become obvious over the last couple of years is unless you're in the top of each category, it's really not going to be something that has, fund economic level potential. And so you have to be in the best, and you have to have ownership and alignment, in the best opportunities. So I think what you're probably going to see is a lot of dispersion equivalently in the different funds. So, funds will kind of separate themselves as to the ones that are consistently outperforming and the ones that are consistently underperforming the market of crypto venture. What we have at least heard from in our LPs are the ones that you can imagine, large endowments on the East Coast, large asset managers all over the world. But what has been the case for them, and when you're an asset manager managing billions or tens of billions of dollars, you basically have an asset allocation, and you say, okay, this much to real estate, this much to public equities, this much to private equity, and within private equity, this much to venture capital. And within venture capital, we have like a small book. We have like a crypto venture program. And so when the bucket of venture capital is in a troubled state, and I would describe the last 3 to 4 years, the last 5 to 6 vintages, which means you raised a fund that's like 2018 plus. Those vintages are in a very tough position. And I just saw AngelList posted this. Basically, no one has DPI from any vintage 2017 fund. The IPO market is basically dead. Anything, at least over the last administration, anything that was over $100 million of acquisition value had to go through the DOJ, basically got brought down as a potential acquisition. So the M&A market has also been completely slowed. And so what this does is, and at the same time, you have higher and higher valuations of private companies, SpaceX, Stripe, all the like $100 billion plus companies that are like waiting to go public. What this causes is what endowments call the denominator effect, where they have a massive over allocation to venture in their asset allocation program because they don't have any distribution. And so what that trickles down into is it says we're not, most of them say we're not doing any new, venture funds or basically any new managers in the venture bucket. And we don't really, have any time to look at crypto because that's a subset of venture. And so it basically cuts off, anyone that was deep in venture over the last decade is basically not in the market for new venture, let alone new crypto venture. And so how this affects is you've got a lot of managers who have, the Lightspeeds and Sequoias and Kleiner Pershings of the world. They've got relationships where their endowments are signed up for 3, 4, 5 funds. But anyone who's trying to break in is not able to do so. And so I think that hurts the allocator market for crypto venture. If you're doing really well, so ways that you can get around this. If you are outperforming, no one will balk, or you'll be able to get a meeting with anyone if you have great performance. Then the rest is kind of up to you to deliver. But I think how this manifests is it's just going to be separation of good from great in the venture landscape, and so people are coming back raising less. Basically, what we've heard at least is most of the venture funds that are in the space are either like in the process of raising or starting their raise basically right now. And this all makes sense. Everybody kind of announced like late 21, early 22 last fundraise, which, historically, 2 to 3 years is how much time you have to invest these funds. And so everybody's kind of coming back for their next cycle. But I think Paradigm announced that they raised 850 or 750, one of the two, down pretty far from 2.5 billion. I think that's representative of what you'll see with most funds. So there's less capital to go around. How this translates to the crypto venture landscape, the actual investing side of it, I think it's a lot. It's definitely possible and probably easier to do the seed round or the lower val A, whatever you want to call that. Very, very hard to do the multi-hundred million valuation rounds, let alone the growth rounds, because the other effect that's going on. Yes, there's liquidity with tokens, but Binance still controls the vast majority of liquidity and activity, and they're not launching nearly as much as they were 3-4 years ago. The bar for getting launched on one of the top exchanges is much, much, much higher. And so once again, if you're the second, third, fourth place in a category, you're kind of not going to have any ability to launch a token that does well. And I think that dispersion is also what's taking over. So yeah, there's a kind of a lot of effects kind of happening simultaneously.
Quick shout out to today's sponsor, Aries Markets. Aries Markets deployed on Aptos in 2022 and is now among the top 10 lending protocols across all blockchains with $280 million of TVL. Aries Markets has expanded its product suite to become a fully integrated DeFi hub combining lending, borrowing, and more. In 2024 alone, Aries introduced several new features to better meet the needs of its users, including native USDT support, an incentive program, and more. Click the link at the bottom of the show notes, head over to Aries Markets, and tell them that I sent you. Hey everyone, quick shout out to today's sponsor, Marinade. Marinade's platform is optimized for institutions to securely expand their exposure to Solana, whether through the provisioning of custodial or non-custodial yield, integrating staking rewards into Solana financial products, or leveraging Marinade's best-in-market rewards rate for revenue and treasury management. Whether you're in DeFi, TradFi, or somewhere in between, Marinade has something for you. To learn more about Marinade, follow the link in today's show notes.
Okay, so I want to talk a little bit about that last point on the Binance side of things. So one of the charts that I find pretty interesting in crypto in general is this DEX to SEC spot volume percentage. And this is going back to 2019. And especially over the course of the last year, the market share of DEXs has grown relatively high. So now we're at about 20 or 21%, which I understand is still far below what Binance is.
That's like 1/5.
Yeah, 1/5. I mean, and I think I'm curious to get your. I just did an episode with Jesse and Austin Adams, so I don't want to front run that. Jesse Walden and Austin Adams, and I don't want to front run that too much. But it seems like the dominant trend, and you actually saw this. Brian Armstrong, the CEO of Coinbase, tweet about this, is just more and more assets are being issued on chain than ever before. And it's kind of overwhelming the listing process for SEXs. And so Coinbase at least has basically said, hey, we need to basically rethink this from the ground up in terms of how we think about listing these assets. But there's just no way that we can do this from a centralized way. And obviously with DEXs, the friction of issuing on a DEX is, 2 orders of magnitude lower, right. much, much lower, right? Also, the pound of flesh that you have to pay to list is much, much lower as well. I was talking to Austin and he mentioned this pretty crazy statistic actually from investment banks that the amount that you as an issuer end up paying to the IBs that are supporting your IPO is actually about 27% of what your selling out into the market. And that's about 7% that gets paid in fees, about 20% in, this is more statistical, but in systematic underpricing of your inventory. So when investment banks go public, they warehouse risk for you, and then their incentive is to get that off their books as fast as they can. So they basically sell at a discount. Binance, from what I've heard, and don't quote me on this, but it's more like 40% of the amount that you are, the circulating supply that you're issuing onto the market. There was some data that got released around this on Scroll. I don't have any specific proprietary information. That might not be totally correct. But still, the word around the street is right. They took an enormous amount from issuers. And what's interesting about this is, these sexes are going to continue to struggle with listing. And the long tail of crypto assets from this like meme coin meta or pump fund meta or whatever it is, meant that the long tail, which frankly was the original product market fit for Uniswap back in the day, has just become a much more important segment. And now actually, with especially a lot of meme coins, it used to be a huge deal when they got listed on Binance. Now everyone sort of knows it's the exit liquidity because of the gap in between when price discovery happens, which is on chain on DEXs, versus when it gets listed on Binance or Coinbase. So if this is the trend and the number of new assets that are being issued on chain just continues to grow, honestly, probably DEXs are in a structurally advantaged position here. And you could see a world, right, where I think it would be a better world where price discovery is happening on chain, and you could see a world where if a lot of like the long tail continues to be increasingly important when it comes to crypto, just because of the sheer amount of assets that are getting listed or that are going live, then eventually you can have enough volume where you can actually start to win some of the larger trading pairs as well. And maybe Hyperliquid has an interesting shot at this, but
yeah. So a couple of things. I mean, I think actually, like, you probably say the vast majority of tokens, because the vast majority of tokens that have launched in the last year and a half have been meme coins. The vast majority of tokens actually have price discovery that exists, at least starts on a DEX, because it's pump and then ring. And so I think it definitely starts there. Historically, what this has meant, though, is that you kind of get, and the market structure is constantly changing, by the way. And I absolutely expect that the market structure will change in the direction that you're describing. It's just a question of when. Currently, where we're at right now is your, at least over the last few years, if you got a Coinbase listing, it kind of implied that they did, regulatory DD on you, and you were kind of safe. Same thing with Binance. Like there was a due diligence process, and there was, I think Binance, like we counted it up, had like basically 60 listings last year. So like almost one per week, but that's like probably 1/3 or 1/4 of what they were doing a few years ago. And maybe even 1/10. I don't even know. And so there's sort of like a higher bar, higher quality level. And so it's sort of like if you get listed on Binance, maybe you had to pay an arm and a leg to do it. And so there's questions there as to like how much of the supply did you give to BNB stakers? But you do get kind of like blessed in a way. And so I think that there is that element of, at least the current market structure suggests that if you're not on Binance, it's hard to have real activity for your token. And right now, real price discovery, real liquid price discovery for any of these massive platforms doesn't happen anywhere other than centralized exchanges. And yes, the hope 100% is that this moves to a DEX. It's a listing. It's not a listing process and a listing fee, but we're not there yet.
Yeah, I completely agree. And it's actually the fact that price discovery happens off chain on these sexes is actually a cost to LPs and AMMs who have to pay arbitrageurs to move the price back to, and at least for like the current design of Uniswap, it's actually not insignificant. This is what people call lever or LVR. So it's definitely a challenge right now. I do think, I mean, just as someone who likes to see more decentralized, on-chain based product wins, it's cool to see DEXs continue to grow in market share. So hopefully that's the case.
We have that chart in our deck.
Oh, really? Nice. Let's go.
It's growing. It's still relatively small. There's a lot of market left to capture.
Yeah. So speaking of meme coins in general, there was a pretty interesting launch this week of Jelly, a new meme coin. I saw Sam Lesson, who is he's the founder at Slow Ventures, which is a pretty traditional Web2 VC firm. Although they dabbled in crypto a little while ago. I know Jill Gunter of Espresso worked there.
That they were like a small investor in the seed round of Solana. And then I think Sam has posted, he like vacillates between extremely bullish and extremely bearish crypto.
So basically, like everyone who doesn't work in crypto, it's like when it's going up, he's bullish. Let me guess. But there was another. I mean, I don't know if you want to just give a quick rundown of this story, which is, there was a sort of unrelated startup, and then Sam and the founding members of that startup launched a meme coin, mostly to just generate awareness. Is my understanding of it, and it's called Jelly.
So yeah, so I think Sam is friends with the founder of Venmo, and I don't remember his name, but Venmo launched in like 2009. It was a massive success from a user adoption perspective. And, the original idea with Venmo was, I think, actually kind of like not that great, which is let's share a social feed of all the payments that you're making to friends. What it became is because it was, and so then ultimately Braintree bought it, and I think bought it for like 28 or $32 million, like a very, very small acquisition, because they had no business model. It was a social payments app. And then PayPal bought Braintree, which owned Venmo. And so it became deeply integrated into the payments stack. And that's really when Venmo kind of took off as a payments mechanism, just because, the deep integrations to the tech stack. And it's like now one of the larger contributors of revenue, I think, to PayPal itself. So goes down as one of the best acquisitions from a dollar perspective. But I think, the founder of Venmo and Sam and a couple of others all got together and launched Jelly. Jelly is a meme coin. It doesn't have any utility, doesn't have any affiliation with Venmo either, but it's just made by the founder of Venmo and a couple of his friends. And I checked last night. It's like it was 200 million market cap, and I don't know, who knows where it is right now. It could be $1 billion. It could be.
Yeah, it looked like it went to 250 million in 3 hours or something like that, which is not financial advice. Just because we're mentioning this ticker on this podcast, don't go out and buy this thing necessarily.
Yeah, 165 million market cap right now. Thank you, Mark. But look, I think what people are testing is, and actually he's not here right now, but shout out Vance for a great tweet on this. We can link to it in the show notes, but basically people are testing liquidity when, you sold your startup too soon for too little. You're like, wait a second, Trump just launched a meme coin off of his likeness and brand. We've got some likeness and brand too. What if we do the same? And I think with Jelly, I did see the dev wallet only has like 1.5% or something like that. So it's not like this isn't like a cash grab. It's maybe not a Haktua coin, but I do think like there's interesting stuff happening where, going back to it, if you're an entrepreneur in traditional technology markets, and you're going to spend 10 to 20 years of your life building this company, which may or may not get bought, it may or may not go public, but you have this like hope of liquidity at some point, and you're looking at what's going on in crypto right now, and you're just like, wait a second, there's a different world. There's a whole better world on that side of the fence. It's kind of obvious as to where you want to play. And if you're an AI entrepreneur and you're looking at crypto and you're like, wait a second, there's actual real things. It's not just like, let's launch a utility-less, valueless coin. I think that there's real opportunity for, a wide swath of these entrepreneurs to come into the space. And yeah, to Vance's point, it's like, you don't have any utility. You don't have any value flowing back to it. And it's going to go up and then it's going to go down. And it just furthers the point that you have to be building something with fundamental utility that's connected to an actual on-chain organization that's doing real things. And at least the way that it currently seems is the best model is have the value that's being generated go into buybacks of your token. And that is the value accrual mechanism that works. And so we're starting to see that play out at scale.
Yeah. So, I mean, one of the other ways that I like that Vance so just actually to build on that point of this, people are calling this, it's fun, like an arbitrage of sorts, right? Where they're seeing much higher valuations given to tokens that have extremely dubious claims to any
Just
sort of cash flow or
the other one, sorry, I didn't mean to interrupt. The other context here is that Vine founders launched a Vine coin earlier this week as well, and so it's not just Jelly and Venmo; it's other startup founders who are doing the same thing.
Right. So I think there's part of this, and actually I'm not actually sure if I can say this on, but I know there are relatively serious people, not even just startup founders, but asset managers that are aware of this valuation gap or mismatch in between token markets versus more trad markets, that they're taking it more seriously. But also, this point that Vance sort of made of, I think this is, and we talked about this when the Trump coin initially launched, and I think I did actually a stream with Santi and Yano, and that might have been on the Empire feed or it might have been on this one, but Alex Kruger had a pretty interesting take on this, which is now there's going to be a bunch of experimentation with he wasn't even thinking about startup coins or company coins. He was thinking about, government coins, right? Or different countries will launch coins, and people are just going to look at this. I think the Trump meme coin is going to break a lot of people's brains. They're going to see how relatively successful it was and how much money got, raised or value got created. And there are going to be a bunch of different types of entities. And there's probably inevitable that startups would do this as well, either as a way to get liquidity or as a way to, it seems like this was more of a publicity stunt and an attention grabber, which if that was the case, then it definitely worked. I mean, here we are talking about it. I think everyone saw this. So I don't know. I think I agree that there's going to be a lot more experimentation along these same lines.
The other thing that I think, the meta of this and kind of what Vance is talking about is there's the market structure bill is hopefully going to be something that crystallizes a lot of the definitions that we're missing right now. And what we've got, and I think David Sachs even said this, he said, look, NFTs and meme coins are basically commemorative items. Think of them as like collectibles. And they could be fungible, they could be non-fungible, but they don't have any utility, and they're not going to be something that you like derive fundamental value from other than pure speculation. That's basically it. And you're willing to sell, you're willing to buy it for whatever price is trading, and you're selling it to someone for whatever they're willing to buy it for, and that's basically it. Then we need a subset category of actual utility tokens. What are the functions of the decentralized protocol? How is it decentralized? How do these utility tokens actually generate value? How do they derive that? How do they deliver that value back to token holders? How do you get to be decentralized enough to have a commodity status? Like all of those questions that were put into the market structure bill draft that went through the House, those will be kind of like the delineation points that say, okay, this is a utility token, there's value accrual, this is a meme coin, there's not any value accrual. But because we don't have the definitional difference right now, everybody's looking at crypto markets and saying, oh, wait, it's just like a meme coin. Wait, maybe there's utility. And I think what that will do is frankly, like quell a lot of the fervor that's going on in meme coins right now, because people will really start to see, oh, this is truly just, a commemorative item. And utility tokens with actual value accrual will probably take off at that point, because the delineation, once again, is like any value enterprising person will be able to look and see, oh, this thing actually does have value, whereas these things don't.
Uniswap Labs is rolling out the red carpet and launching a $15.5 million bug bounty. This is the largest bug bounty in the entire history of crypto to anyone that can find a critical bug with the Uniswap v4 protocol. This bug bounty aims to make it the most rigorously reviewed code base ever deployed to Ethereum. Now, the Uniswap name is basically synonymous with security. $2.4 trillion in cumulative volume has passed through Uniswap v2 and v3 without a single hack. So Uniswap v4 is dedicated to bringing that same level of security and transparency to the v4 protocol. So if you want more information or eligibility or scope or rewards or payout or any of that good stuff, there's a link in the bottom of the show notes. I highly recommend that you stop listening right now, go to the show notes, click the link, head over and tell them that I sent you. Start earning money today.
Maybe we can close on some of the comments that Jerome Powell made actually during the FOMC, which felt pretty interesting along these lines, which was, so we had the FOMC this week. This is the once a month augur that everyone likes to try to read Jay Powell's facial expressions to understand where the market is going to go. It's like our own monthly repeating version of Groundhog Day that we do. Anyway, apparently, like, it was a good FOMC from just the perspective of his tone and some of what he was indicating about where he thought inflation was and that type of thing. But he did mention explicitly that, he talked a little bit about crypto and basically said that it was okay publicly for banks to support, these types of services. And that was a super interesting comment for him to make. Historically, I think Treasury has been relatively opposed to crypto, or certainly anything that even smells like banking touching crypto rails. And so obviously that doesn't mean that anything is going to happen overnight, but it did seem super encouraging, at least from my perspective. I don't know what your thoughts were.
No, exactly. And I think people are reacting to that. Look, I think broadly the last few weeks and, basically post inauguration has been a complete breath of fresh air in terms of the tone of the administration and the direction from a regulatory or legislative perspective as to where we're going. You got Hester Peirce leading a crypto task force at the SEC. You've got Cynthia Loomis, talking about all the initiatives that she wants to get done on the Crypto Council. And you got the head of the Fed saying, hey, we can enable crypto payments. And how this translates. And we've talked to, leaders of digital asset teams or the digital asset teams at these major banks, the Goldmans, the JPs, the Bank of Americas. Even Brian Moynihan at Davos said, like, hey, when they say it's ready and it's good for us to go, like, we're ready to go. And that's the sentiment across all the banks is like, we haven't just been waiting and like hoping that this industry goes away. We've been building. And we just don't know how to interact with it yet from a bank regulation standpoint. I think once given the all clear, it's going to move pretty quickly. Payments is going to be the thing that happens first. And banks are going to look at crypto and be like, well, we can just build an international payments network with this. And stablecoins is a great mechanism for doing that. They're also going to, SAB 121 is repealed.
Yep.
What banks are also perfectly positioned to do is give loans against crypto.
Yeah.
And they're going to have a lower cost of capital than any other provider. So if you want to put your Bitcoin in your JP Morgan account and borrow against it, I'm sure they're going to have a product to be able to do that soon. So I think a lot of the positive things that we've been hoping for are on the way. I do fear in the same way that everybody, I can't believe people are still talking about this, but like the government's going to put a TWAP on Bitcoin and have a strategic Bitcoin reserve. It's like, guys, that's not going to happen.
Yeah.
but maybe, we're just not going to sell the ones that we have. In the same way, I think all the banks are like, oh, we're going to launch a bunch of tokens and we're going to have them like get launched via JP Morgan or Goldman Sachs in the same way that they do IPOs. It's like, no, they're not going to do that. And so the expectations of what this enables, I think, are always going to supersede what the reality is. But any positive developments that further entrench the banks into the crypto landscape is positive because they move from foe to friend.
I completely agree. And, I think when at least I think about what how banks are going to want to interact with blockchains, I do think that they're going to want man, I can't remember if we were talking about this, but I do think a lot of the enterprise. Do you remember people used to debate enterprise blockchain back in 2017 and 2018? And yeah, but some version of that is probably what ends up coming to pass. Like a lot of these banks are going to need their own permissioned environments, right? Even if you look at how something like Biddle works today, it's permission. You need to KYC to interact with it. I actually just saw that Apollo put one of their debt funds on chain today as well. Let me look up actually what the exact details for that were.
Fortress has been looking at doing this with one of their distressed funds, distressed debt funds. Look, you've got BlackRock CEO saying it's time for the SEC to allow for the tokenization of equities. Like that, it's not going to happen immediately. Eventually that will happen. When that happens, I don't know. But the ability to have that in and of itself is such a massive win for the industry. Now, it's not going to mean that you're going to be able to go put your tokenized Apple, at least initially, you're not going to be able to put your tokenized Apple that is, technically held in the brokerage of Goldman Sachs onto Aave, but it'll be tokenized, and maybe the next step will be that you have other services that are within the four walls of Goldman Sachs that allow for other services within their blockchain ecosystem, but it's not going to be something that you're going to be able to remove from their four walls, I think.
Yeah, and I think that there's an interesting discussion to be had here as well around how these institutions are going to where are they going to decide to deploy, and also like how can we retain some crypto values or the ethos or some of the benefits of deploying onto permissionless global ledgers. And it feels very likely to me that banks are going to want entirely permissioned environments. Like I could imagine something where you have to KYC at the sequencer level or something like that, and everyone who's operating at that within that environment is a KYC person, that type of thing. However, one of the benefits of Ethereum, right, and being an actual L2 is you have things like an escape hatch. So there are these like small incremental benefits that I could imagine where, okay, maybe just because of how efficient blockchains are, you drive down some of the services, and there's still a Goldman Sachs or JP Morgan walled garden, but you have these other benefits of being able to opt out and escape down to L1 where it's less censored, things like that. And
anything that has to do with a financial service institution is going to be KYC. Just make that assumption right now.
Yeah, totally. And it's interesting to see how maybe path dependent. There's this whole we're all building the same thing and converging on different models, but it is interesting, right? Like Ethereum has taken a little bit of a different approach here with than Solana, and Solana. One of the benefits there has been they've been one shared layer. They've got a bunch of activity there. You've seen a bunch of DEX volumes migrate over there, but they're not as friendly with L2s. And it's been interesting, at least for me, to see. Oh, I haven't asked you about this, but this is public, so I don't know if you could comment or whatever. But I know, an ex framework Gigabrain, and now most recently Jump, ex employee who's being sued by Jump is spinning up basically a new L1, which is inspired by his work on Fire Dancer. And it's been interesting. And there was another chain that launched, which is a fork of Fire Dancer, Fogo. And it's been interesting to see. I sort of assumed that these would just be L2s, but they're not L2s. They're new L1s. And that could be for valuation reasons. It could be because it's much more difficult to build rollups on Solana than it is on Ethereum. And so maybe these paths end up diverging a little bit more at the end of the day than at least I had originally thought. It's something to think about.
Yep. I think that's 100% the case, and can't say much on the subject. I do think Photo and Unto are pretty different, but Fire Dancer is open source, and it's an open source protocol. It's an open source project. That's how these ecosystems build themselves. And the other part that I thought was interesting was Brian Moynihan from Bank of America. I didn't see this. I saw this in a tweet, so I hope it's actually credited to him. But he said, as soon as we get the all go, we're ready to start filing patents. And it's like, dude, you're totally missing the point. And patents is just not the way, and like IP rights is not the way that this industry works, because it's all open source technology, it's software, and you have to build your moat in a different way, which is community and engagement. And it's just a totally fundamentally different construct. It kind of reminds me of 2018, 2019, when Nike filed the patent for like shoes on chain. It's like, oh my God.
I know, which is funny. And, that is, there has been this broad assumption that, banks will just win. And, it's basically depending on which side you're on, right? If you're more on the crypto native side and you like startups and VC, you're sort of like, oh, these banks are going to get disrupted. And if you're on the finance side, they rarely entertain the idea that this could be real disruptive potential here. The moats that, financial institutions have is obviously capital. There's a regulatory moat, and they have trust, right? Like I think trust is actually a massive moat for financial institutions, but nothing is.
They have users that have trust. Those two
right. They have users that have trust, right? Like you have, I mean, even for me, right, who's like extremely deep in the weeds, and but holding assets in Fidelity, I feel pretty safe about that. Bank of America, I feel pretty safe about that. So, but over time, right, you can start to chip away at those moats. And if banks and financial institutions have completely the wrong idea of how to compete in this space, they can't. Those moats can get eroded over time for sure. So, I could imagine these two worlds smashing together and small subsets doing much better than other subsets. But
yeah, I can see multiple ways that this plays out. I think it's possible that we are on a complete competitive plane with the banks over the long run, and it's sort of like us versus them, zero sum. I also actually more so think that there will always be a permissionless ecosystem that exists that is adjacent to the financial ecosystem that exists. All of it will be powered by blockchain. If you want to, do things within the Fidelity ecosystem, you got to be KYC, you got to be a Fidelity customer, and you've got like select services that they enable that are within their four walls. And if you want to do some of the more like fringe, creative, out there stuff, like that's going to be in the open and permissionless world. My bet is that the open and permissionless world will kind of take over the long run, but they'll for a while live in parallel, and all of it's going to be underpinned by blockchain. It's just one's going to move faster because it's going to be open.
Yeah. All right, Michael. I think that's probably all the time we have for this week, but this was a fun one, my man, and I will see you here same time next week.
Yes, sir.